Let's talk about people risk, which is also known as conduct risk. And as the name says, this is the risk of losses due to inappropriate behavior by employees. They may be greedy, they may take on a lot of risk, they may actually cheat their customers, and many other variations. Let's take a look. People risk is the risk associated with losses due to the actions of personnel. And these can be either due to personal greed, negligence, malpractice, or any combination of these. It's also known as conduct risk because, in most cases, employees cause losses due to their conduct in specific. There are many variations of this type of risk. For example, excessive risk taking as a trader, for example, avoiding the limits or keeping hidden accounts with losses. Another type is interest rate fixing. For example, the LIBOR fixing scandal. Since the LIBOR is an average of the rates that banks charge to lend to each other, banks would collude to provide false numbers in order to pretend to be stronger or just charge more of clients. For example, if the true LIBOR rate was 2.5%, they would lend at 3%. So the bank managers can lie and say that their estimate for LIBOR is 3% instead of 2%, because now they can lend at 3.5%. So the difference in the interest that they gain would be 1% instead of 0.5 at the expense of the retail borrowers. Another example is mis-selling products or just taking advantage of consumers in general. Predatory lending with high interest rates, bank accounts with hidden commissions, or selling insurance that borrowers don't need, such as the PPI scandal in London, and so on. Or, for example, facilitating transactions with sanctioned persons or politically exposed persons. This is part of anti-crime compliance. Look, there's always a tension between obeying compliance, flagging every suspect transaction, versus obtaining bigger bonuses and making more profit from processing more transactions without looking at the clients. There's always a balance, but many bankers decide to tilt that balance towards less compliance and more profit. And finally, actually facilitating financial crime in other forms, performing some kind of Ponzi scheme with investment products, bribing people, helping clients evade taxes, not filing suspicious activity reports in terms of anti-money laundering compliance, and many others. There are several causes for conduct risk, naturally. People can behave badly due to a lot of reasons, but some of the main ones that are worth mentioning include: first, misaligned incentive systems. For example, having trading bonuses that promote higher risk taking for trading, or that promote lower quality loans for bankers, or that promote avoiding anti money laundering or counter financing of terrorism compliance for private bankers. In short, the incentive systems for personnel incentivize disregarding compliance. Another is high levels of rotation. A high level of employee turnover means new and untrained personnel, which can be incompetent, but it also means a lack of long-term loyalty in key people, which makes people focus on short-term profits and not the sustainability of the bank or financial institution. Someone that's been at a bank for 1 year will never be as loyal as someone who has been there for 10 or 20 years. And finally, lack of function integration. And by this, I mean the control functions in specific. If the risk management and compliance functions are not integrated with the different departments, they may not fully oversee all activity. They may not have enough resources, enough power, or just no operational oversight in day-to-day operations. What are some examples here? The first is that this can be a cultural issue. The culture of personal enrichment is present in many banks. So even if a specific employee is fired for lack of compliance, their boss and their whole team may just do the same. The company's general culture matters a lot. Then, there is an overlap with process risk here. In specific cases where a person fails due to not properly executing a process, it may be due to the internal process and not due to the person. What I mean is, if you have a very complex process with 30 steps and an employee skips one of them by accident, maybe it's the person's fault, but hey, maybe it's also the process's fault. And finally, conduct risk can cause a break in complying with regulation in any area. So remember, for banks, we have four compliance areas in total, which are microprudential, macroprudential, anti-crime, and consumer protection. And people can cause trouble in any of the four. So they can calculate regulatory capital the wrong way, or they can do regulatory arbitrage, where they find the most dangerous way possible to comply with regulation, or they can actively harm consumers, or they can have a lack of anti-money laundering or counter-financing of terrorism controls. Any of these can happen, and that's not a coincidence. A lot of bank compliance comes after the fact, precisely to prevent problems that have already occurred. What are our key takeaways for this lesson? The first is that people risk, also known as conduct risk, is the risk of losses in a bank due to specific activity by a person, which may be intentional or due to negligence or even incompetence. Then, although there are various executions of conduct risk, including risky trading, allowing sanctioned individuals to transfer money, and so on, most motivations revolve around an employee being greedy and taking risk, or even facilitating crime for their own benefit. The general pattern is greed. And finally, conduct risk usually occurs either due to improper management practices, that is, having the wrong culture or not keeping people in the long term, lack of integration of control functions, that is, risk management and compliance don't have any oversight over operations, or people, just lack of training or loyalty of the people that actually work there. So as we see, there are many forms that conduct risk can take, and it can occur at any level of the organization, in any function. And the causes can be varied. It can be due to the company culture, due to processes themselves, and many other reasons.